Hello everyone. In today's video, we will understand an important statement made by an RBI Monetary Policy Committee member regarding GDP growth and inflation. Why we are going to discuss this particular topic means this topic is very important for UPSC aspirants, SSC aspirants and banking aspirants and also different state related PSC exams preparation aspirants. First of all, let's see what is in the news. Recently, an RBI MPC member, Monetary Policy Committee member Saugata Bhattacharya has said that India's GDP growth may slow down in the coming quarters because inflation is gradually moving towards RBI's target of 4%. So, this statement is fully aligned with the RBI's December monetary policy resolution. Let's understand inflation. Let us first understand the inflation. In India, RBI follows a system called flexible inflation targeting. Under this system, target inflation is 4%, allowed range is 2% to 6%. Now, according to RBI projections, consumer price inflation in financial year 26 is around 2%. Consumer price inflation in financial year 27, quarter 1 if you take, it's 3.9%. And if you take it in quarter 2, which is 4%. This means inflation is normalizing and coming close to RBI's target of 4%. Right? Now, what about GDP growth? Now, let's understand GDP growth. In the first half of financial year 26, GDP growth was unexpectedly high at around 8%. But in the second half of financial year 26, the growth is expected to slow down. If you take quarter 3, financial year 26, it's a 7%. And quarter 4, financial year 26, it's a 6.5%. In financial year 27, quarter 1, it's a 6.7% and quarter 2, it's a 6.8%. So, overall, the growth is moderating, not collapsing. Why is growth slowing? Why is GDP growth is expected to slow? So, there are three key reasons for this. First one is lower inflation effect. So, earlier inflation was lower than expected. Even wholesale price index inflation was sometimes negative. This made GDP numbers look artificially high. Second one is manufacturing not overheating. So, capacity utilization is around 74 to 75%. So, earlier it used to be around 80%. This shows there is no excessive demand pressure. And the third one is stable global prices. Metal prices are stable. Crude oil is expected around $60 per barrel. No major cost push inflation pressure right now. So, hence the economy is not overheating. So, in this case, what is Reserve Bank of India action? Repo rate cut. So, earlier this month, Reserve Bank of India's 6-member Monetary Policy Committee reduced the repo rate by 25 basis points. Now, new repo rate is 5.25%. Why? To support the economic growth, because inflation risks are currently under control. That's why, right? So, will RBI cut rates again? When asked about future rate cuts, the Monetary Policy Committee member said RBI will not give forward guidance, decisions will be taken. Meeting by meeting based on data and emerging risks, they are going to take the decisions. This shows RBI's data-driven approach. So, here we have to remember few things key exam takeaways. For exam's point of view, if you take, you have to remember this thing particularly. The policy interest rate is now consistent with macroeconomic stability. This means inflation is under control, growth is supported, no sign of overheating. This reflects Reserve Bank of India's balanced monetary policy approach. This is a very important current affair. If you take in point of current affairs, it's important, and at the same time in economy side, this is also very important. Thank you very much.